Coming up next on the Joe Simon Podcast, the real things we need to know about Roth IRA conversions, not contributions. Stand by for news.
And now, broadcasting from Titletown, USA, here's Joe Simon.
Well, we're talking about Roth IRA conversions and not contributions. And I start that out because of a recent story. This is a true story. It's about an executive who earns a lot of money and actually is in direction as the CFO of his corporation, privately held corp. And we're talking about him and 3 or 4 or 5 executives earning a lot of money, as well as other people earning a great living at this privately held company that's been around for 75 years. And through the discussion, as we're talking about, the phrase I like to bring up often is tax beneficial strategies, he kind of rolled his eyes. After all, he's a CFO. And what became readily apparent quite quickly was that he was limited to how much he could put into his 401k because of his status as a highly compensated executive, as well as 3 or 4 other people. So as we talked through it and we looked at the qualified plan, the 401k plan description, it was very interesting to find out that they did not offer a Roth 401k option. This was the first thing I brought up when we were talking. I told him with the amount of money you're making now and the trajectory of this corporation and the plans that you have for it in the next 5 years, taxes are probably the number one concern out of the whole deal here for himself and for other executives. And as we paged through things, we really found out that a Roth 401k option would have been first base and taking care of some basics to getting rid of taxation on dollars today and never ever paying taxes on those dollars again. And the stumbling block that he had with this, as well as his HR director, was they both felt he did not qualify for making contributions to a Roth. Key word. The phrase didn't continue. It was just a Roth. And the rule number 1 here is there's a difference between a contribution, underline the word, and a conversion, triple underline that word. And we'll come back to the benefits of having a Roth 401k in a minute. But back to reality and what we're dealing with here in real time today is that we must get that Roth 401k option built into the 401k for all employees, regardless of what they make, to participate as an eligible employee. Now, I realize there are some taxes that go into this. I also believe, and you'll have to check me on this one, but I believe if it's a match 401k, the contribution that the employer makes remains as a tax-deferred contribution, but all other money that the employee participant is putting in when chosen to go into the Roth 401k side is after tax, never again tax dollars. So check me on that, footnote me on the amount that the employer's matching. Does that remain pre-tax until he retires and pulls it? Or does he pay the tax and then it mingles with this Roth 401k money? That's an important thing to know, but it shouldn't be a deciding factor on why you want to participate in this Roth 401k option. And why employers listening now, why don't you have a Roth 401k? It's an option that everyone in the company who's eligible can choose. Outstanding option. Never ever again taxed money versus tax-infected money in a traditional 401k. And why do we say tax-infected? It's because it will be taxed someday when taxes most likely will be at its one of its highest rates down the road into the future as we look at 39, almost $40 trillion of government debt. They count on our money coming out of our tax-infected 401ks to pay taxes so they can use that money. That's a whole nother day when we talk about how the government spends money. We're talking about your money today, my client's money today. What's the best way we can use this? What's the tax beneficial money strategy for this? So the number one thing is get into that Roth 401k that your employer offers today, ASAP. There's the limit that the highly compensated employee has in participating in that Roth 401k is the same limit he or she is subject to as a highly compensated employee on the traditional 401k side. That's it. Now, for somebody that has old 401k money, old IRA money, possibly looking at a in-plan distribution, an in-plan withdrawal, I believe it's technically called an in-service withdrawal from your existing 401k plan, for whatever reason, you're not borrowing from it, you're doing an in-service withdrawal, which means you're still working, you're still contributing to the plan, but there's some money that's accumulated that you'd like to withdraw while in service as an employee and take it elsewhere into another qualified either Roth setting or traditional IRA setting. Ask your HR department or your plan administrator if your plan has that clause. It's not mandatory, but 70% of the plans today have that. Another caution here is if you're younger than 59 and a half, things get a little more complicated and we want to slow this down and have a greater discussion on it. And always when you're 59 and a half or younger, there's lots of questions around that. So today's conversation really is talking about that person in that red zone, over 60, over 62, maybe. And why we say that is because as we look at our government debt situation and as we look at where taxes are today and possibly moving into the future, a bird in hand is saying taxes are at a very low situation today in 2026. There could be an opportunity for you and your house and your financial strategies. So what is the difference between a Roth conversion and a Roth contribution? And we'll kind of end the episode here today on this interesting subject. First of all, there is a personal contribution limit for people when they're trying to get into a Roth IRA, just straight off the street, not money that's in another qualified plan now, and you want to bring it over. That's a Roth conversion. The contribution is someone that's saying, I would just like to do a post-tax contribution to a qualified retirement plan. And there is a minimum amount and a maximum amount. Minimums are usually set by the investment you're taking it to. Maximums are set by the IRS and the federal government. So we want to be aware of what those are. We want to be aware of your ages. We want to be aware of IRMAA as we come up to this Medicare situation. IRMAA does a look back of 2 years on our wages and then determines if we're going to get the lowest possible rate for our Medicare as possible. What would really be a shame is if someone did a Roth conversion, which is a beautiful thing because now you've taken control of taxation forever for yourself and your earnings and your growth. There's no taxes on RMDs. There's no RMDs in a Roth IRA, the Roth setting. That's where you're taking it when you convert it from traditional to Roth, a Roth conversion, a Roth IRA. But there are dollar limits when we personally want to do it, just money earned and then walk across the bridge and pay that tax and then put it into a Roth IRA. That's where we get concerned about those sorts of things. Where we also get concerned is if we were to do, for example, a $250 contribution from a traditional IRA to a Roth IRA. And things become very interesting. I'm looking for something that I worked up here earlier today, if I can find it quickly. So the scenario is someone age 65 in the year 2026, and their earnings are $100,000 this year, but they do a $250,000 conversion from a traditional to a Roth in 2026. This is going to cause your income on paper to skyrocket and push you into another tax bracket. The taxable income after the eligible deductions, married, both 65, filing jointly, in 2026 is $314,500. The current IRMAA cost is zero, because what they do in this particular case is look at what you earned this year because you now are 65. And the surcharge for this is $5,769.60 versus if you weren't converting that full $250,000. We won't get into all those details today. But my point, and I hope you're catching this, is we just did a good thing with a good strategy, meaning let's pay some taxes on great hard-earned money in your retirement account, moving it to a Roth conversion now, Roth IRA. It gets lumped in with your 2026 earnings, and it multiplies it by a great amount. 100,000 in earnings, now up to 350,000 earnings, and most of that becomes a taxable picture that IRMAA takes a look at and is explained in their ratios, their schedules. And now we end up paying over $5,700 in a surcharge because we did that lump sum. So what do you think the answer would be with this sort of summary of a case description? What do you think the answer would have been, the smartest way to handle this? You're right, not do the Roth conversion, but possibly spoon feed it, wave it in, maybe do a 3-year, take this 250 and divide it by 3 and spread that out over a 3-year period of time. So we're under the radar and we don't have that $5,769.60 surcharge. So that's the walkaway today. We love the Roth conversion. It's a great discussion to have. Everybody is eligible to participate in this. It's just in the way it works for you in your house, in your camp, in your dollars, in your earnings, other things you may have sold along the way during that tax year. And what was the first thing we opened up today with? Started with Roth and ended in 401k. You're right. The Roth 401k option. We have to take a look at that. We have to figure out how we take advantage of that. That's square number one in all of this today. So let's be in touch. And as always, have a prosperous day.
You've been listening to the Joe Simon Podcast. Big ideas with powerful stories and real-time solutions. Business succession planning, executive benefits, employee benefits, tax beneficial savings, and more. Remember, information discussed here today is dated and not specific to your situation. Always seek personal counsel from qualified advisors. Joe Simon is a licensed insurance agent in the state of Wisconsin. Licensed to advise on accident and health, life insurance, disability insurance, and annuities, as well as qualified long-term care insurance.